Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Jared Blikre, your host, and with me is my co-host, Yahoo Finance senior reporter Brooke DiPalma, who's here to connect the dots and to be that bridge between Wall Street and Main Street. Today, we're going straight into the AI arms race, and we've got a former chip designer turned Wall Street analyst to help sort things out. Our word of the day is hyperscaler, because in AI, a handful of giant buyers can set the pace for everyone else. We clear the air on exactly what these giants do. And for today's market show and tell, we're looking at Nvidia through a fundamental lens. We're breaking down gross margin to show how it can swing the stock price when the cycle shifts. And this episode is brought to you by the number 53%. Remember smart glasses? They're back, and that's how much demand is expected to grow this year. And today, we are welcoming David O'Connor. He is a senior semiconductor research analyst at BNP Paribas and a former chip designer who spent a decade building silicon with companies like NXP and Texas Instruments. From the clean room to the street, David, it's great to have you here.
Yeah, thanks so much for inviting me, guys.
So let's begin with your big picture overview of how you see the AI trade playing out right now.
Oh, big question.
Yeah, straight into it. No softball there. I would say on the semiconductor side of things, sentiment is quite tricky at the moment. A lot of wall of worries, I would say, for a lot of investors. Worry on the disruption AI is causing. We've seen that more on the software side or software stocks in the last couple of weeks, but also on the hyperscaler. Concern around the ROI, concern around monetization. Also on the CapEx side of things as well. We've got like 700 billion this year for just hyperscaler CapEx, up 70% year over year. But the question is, how much higher that can go. And there's no good answers, I would say. So certainly right now we need better answers to these questions to kind of get us through this wall of worry and onto the promised land.
All right, let's stick with
land. All right.
let's stick with that theme because our word of the day is hyperscaler, and that's a giant cloud operator that runs massive data centers and networks at a global scale. In the U.S., think Amazon, Microsoft, Google, Meta, and Oracle. And the reason this word matters right now is that in AI, a handful of these giant buyers can set the pace for everyone else. When they speed up spending, it pulls the whole supply chain with it: chips, power, networking, all of it. And when they tap the brakes, it can hit hardware demand pretty fast. The misunderstanding is that hyperscaler sounds like a cloud buzzword, but it's really a market power word. It's about who has the checkbook, who gets priority, and who can turn AI into a real business. So David, from your seat on the sell side, what's the most important thing that people need to know or get wrong about hyperscalers right now?
Yeah, I think the most important thing for people to understand, because they are representing 70% of the AI market, so they are, as you mentioned, writing the checks. I think the thing to realize is that they're well funded, so they can afford, and that's what is a bit different now versus if you look back at previous cycles, back to the tech bubble in 2000. There was no cash being generated, so the guys who are actually buying all the infrastructure, buying all the chips, as you talk about, the connectivity, the power, they were not funded. They had no real business model. So that's very important to understand here, that this spending can continue. And as I mentioned, this year, 2020, calendar 26, probably 90% of, that 700 billion represents 90% of their cash flow. So quite elevated, but at the same time, they can afford it. You could say.
You mentioned earlier within your first answer that ROI for these hyperscalers, that's return of investment. When you think about these names, where are we at now? Because that was really the fear back in the fall. And so has that fear eased at all heading into this year?
Yeah. So it's the same concern we had 3 years ago, 2 years ago, last year in September, as you mentioned. It hasn't gone away. Still the same questions. But now we need better answers. And those answers aren't really forthcoming. When we look at the hyperscaler, they are monetizing initially to a certain extent through better click-through rates, better advertising. So there is levels of monetization there. But I think we need to see a lot more, like 700 billion in CapEx this year. Wow, that's
I mean,
such a
why not
big
trillions?
number.
Yes.
That and of course we see OpenAI Let's talk about their kind of revenue run rate, and Tropic as well. But there's a big gap there between these hyperscaler investment levels and what these guys, their run rate basically. So yeah, so it's for sure better answers, not new questions, but certainly we need better answers now, given that we've had 3 years of infrastructure build out so far. Is what's going to drive that going forward? Is it going to be just one more year of infrastructure build out, 6 months? There's uncertainty there. And to kind of make that bridge from infrastructure to actually monetization, we need answers there. We need to see business models. And that's the big concern at the moment.
It sounds like we just have to wait a bit of time for these answers, but the market's always going to front run something. Let me maybe this is unfair because I know you're a chips guy, but I want to ask you about the software side just because it's gotten decimated over the last few months. And we saw this huge washout just a few weeks ago. And I guess the big overarching theme is software as a service is going to be disrupted by AI. Elon Musk is out there saying that coding is dead. You're just going to have one software app to control everything. Who knows? But do you see a bottom in software coming? And do you think that's important to the AI rally?
I spent 10 years in the industry and 15 years on the sell side. So seen a lot of new technologies over the years. And I would say, there's parallels what we're seeing at the moment where you have all the tools built out for a new kind of technology, which is AI. And, as those tools are built out, now we're in the stage where we're getting more of these AI agents come to the fore. And to your point, every week now, we seem to have a new AI agent that's coming out and causing a lot of questions around existing business models that have been there for many, many years, either tooling, workflows. All these AI agents are pretty disruptive. Now, is there value in them? Someone working on an agent over the weekend and coming out Monday morning with something
or you
that's
publish
really...
a paper, erase $1 trillion in market cap value, but does the rubber meet the road there? I
Yeah,
guess.
exactly. And to your to your question, where does this end? I would say, so we're at the stage where there's question on incumbents across the space. Obviously software impacted at the moment. I think as we go through this year and we see more and more agents, there's going to be more questions asked. But I think out of this as well, as I mentioned, how much value is actually attached to these agents, it's not very clear, and how disruptive they're going to be long term, and can they kind of really build a big ecosystem around that? There's question marks there. So yeah, like we've seen previously, it's up to the incumbents to actually go out there and prove and disprove these new disruptors, and to actually show that AI is actually an accelerant to their businesses. And but that takes time. It's easier to show your disruptor and than to disprove that. So I think this concern is going to remain with us through this year until those big incumbents can show that actually they've adopted AI and it's driving new revenue growth for those businesses.
New
All
era.
right, big overhang for the rest of the year. Time now for market show and tell, and today we're breaking down gross margin, using Nvidia as an example. Gross margin is just the share of revenue a company keeps after it pays direct costs to make and deliver its products. So when gross margin is rising, it usually means stronger pricing power, better product mix, or lower cost per unit. And we've got a chart of Nvidia stock price versus gross margin going back to 2019. And for our audio-only listeners, I'll describe it. Both are up over the last 7 years, but with a couple of detours. In 2022, gross margin took the down elevator because of gaming hangover that was inventory piling up in the channel, prices resetting, and charges tied to clearing that inventory. Then in 2025, you had a different kind of pressure, a big new product ramp for Blackwell chips, where early units started out with lower margin, plus China export restriction headaches that were forcing write-downs on certain chips. And a quick note on the charts, we get Nvidia's stock price in real time, but we don't get the final metrics like financial metrics like gross margin until after each quarter end. And in general, you don't really use company fundamentals to time the market. Having said that, David, how do you use gross margin in your analysis for companies? How important is it to you in your models?
Yeah, great question, Jared. Gross margin is fundamental to any company, really. It actually shows how much value they're delivering. So taking their basic raw materials, adding value, whether that's hardware, whether that's software, and charging for that. And, that's where companies will pay. When you look at Nvidia, you talk about Nvidia there, that mid-70s gross margin that we're at the moment. Obviously, quite a very strong gross margin relatively to the semiconductor industry. In general, I would say semiconductors, you're probably going to attain maybe 50% gross margin. So in AI, obviously, it's a new technology. It's a hot technology. There's a scarcity element as well. You can charge for all that. There's a bigger software element as well. And Nvidia is doing a tremendous job capitalizing on that, I would say. Now, there's always puts and takes to that, but right now, in the space, some investors are concerned that kind of the sustainability of that level of gross margin in that kind of mid-70 range. I would say, from my perspective, Nvidia is the fastest runner here in this AI chip game, and there's value in being the fastest runner. And that's why I would see it as sustainable going forward, given the breakneck pace that kind of AI is progressing today.
And really quickly, when you think about where Nvidia sits, it sort of has like become the poster child of this AI arms resolution, as Wedbush's Dan Ives have put it. What would you tell investors who are maybe only thinking of Nvidia when it comes to this AI arms race?
Well, like any technology, there's probably room for just a couple of players. There's room for the first guy who's the fastest runner, and he typically attains 70-80% of the market. Conceptually, number two guy, then maybe 10-20% market share. And then the third guy, just less market share. And anyone else behind that is out of business. So, it's quite we've seen this over multiple generations of technology. So it's very important to be the first guy and to be the fastest runner to kind of secure those big design slots at hyperscalers.
Real quick, what makes Nvidia such a fast runner here?
I would say they started sooner than everyone else. Absolutely. They engaged, Nvidia when, you talked there about the gross margin pressures that we had many years ago due to kind of crypto and maybe more gaming. But back then they actually engaged AI developers, AI labs sooner than anyone else. And they actually kind of created that software ecosystem around kind of AI.
Shaped the
And
industry.
they, in one way as well, they had a product that was perfect to run AI workloads, right? Which happened to be gaming chips. So, there's an element of being first, development, the foresight of the company to actually kind of say, hey, this could be a huge market and support that. So yeah, there's, multiple things went into it, but essentially in the end of the day, it's they got there first and they're the fastest runner.
So all eyes on who's in second and third place, but we do need to take a short break. Coming up, we're talking the latest AI tech, and we've got a run rate showdown that takes a bite out of the AI spending race. This episode is brought to you by the number 53%. That's the projected year-over-year growth in AR glasses shipments this year, which is kind of wild because smart glasses were supposed to be the next big thing last decade, and instead they turned into a very expensive science project. But here's why they might finally have a brighter future. Apple's reportedly planning up work on AI-focused wearables, including those smart glasses, as part of a push towards AI hardware built around Siri and visual context. So, David, how are you thinking about these next-gen glasses evolving, and what sort of features do they kind of need to have in order for users to think that they're worth buying here?
Yeah, interesting. So moving over to the consumer side, it's, we were at CES in January. The big, obviously, electronics show happens every January in Las Vegas. And I would say every second booth at the show was pretty much around AR glasses.
Oh, wow.
Lots of Asian suppliers, showing their wares, basically. Lots of US companies involved in this. So certainly you can feel that the technology is now on that cusp of adoption. And for sure, I think this year we're going to see it as probably the number one holiday product would be my guess.
Ooh.
The AR glasses are not new, to your point. They've been around many years, but the form factor wasn't there. The technology wasn't quite ready. The use case as well. I think now, the form factor is there. They're now light enough with the technology that we can actually wear. So the tech is there, the form factor, and from here it's just all about the features. So still maybe lagging a bit on the features, I would say. It's a bit more Space Invader-y still, I think, to draw an analogy from gaming, but they're progressing very fast. And I think, they're going forward. I would see AR glasses as kind of, on that kind of the knee of the curve here in terms of, where they're about to take off. So very, I must say, I came away from CS pretty excited around AR glasses
What
going
about some of
forward.
the other wearables? Like there have been pins that you just wear on your vest, your shirt, your lapel, and I've seen these over the last few years, and the first ones just didn't get any traction. But now you've got Apple supposedly getting into the game. Where do you think that space ends up?
Yeah, I think there's multiple other accessories that kind of come and go. But I think the big guys like Apple, guys like Meta, are really focused on kind of things like AR glasses. Lots of news flow out there around that. So it's more on those devices than kind of more than the accessory side of things. The accessories, it's tricky. I would say, depending on the different gadgets. But yeah.
Anything excite you at CES besides what we talked about?
I would say outside of AR glasses, robotics was the
Mm.
other kind of application that's really on the cusp of adoption here. It's more on the kind of B2B, more on the industrial side of things, but having these humanoids kind of robots,
They were at
helping
the
us.
Olympics, yeah.
Yeah, that was pretty crazy.
Exactly, the helping us in different applications on the factory floor.
Right.
So again, that's another application that's been around for many years. But I think really now, as we go into more 2027, the technology is ready. The application is there. Maybe there's still a bit of work to do on the acceptance side. Us they accept these humanoids wandering around,
Mhm.
learning, following us around and learning what we're doing. But again, can deliver massive value. So humanoids is the other area and technology I'm pretty excited about coming out of CS this year.
And a lot of investors around Tesla making a big bet on what exactly that could turn into. Is
Which
that
is which is a good. What companies are really investable in this? I mean, Boston Scientific comes to mind, but I don't know many others.
Yeah, there's there's some that are directly involved in that. Obviously, Boston Dynamics. You mentioned Tesla as well. All these guys are pretty excited around those, and they have their own offering. From a semiconductor perspective, I would say, again, play the picks and shovels guys.
Mm.
So that would be the analog names, the analog semiconductors. So in my coverage, it'd be guys like Texas Instruments, Analog Devices, Microchip, NXP, all these guys who have all the sensors, all the compute chips that you need to actually kind of make these robots work, basically. So pretty exciting from the analog names that I cover. They have the kind of key technologies there that any humanoid needs. I would say, just to give you one data point, on average, kind of there's about as much semiconductors in a humanoid, about $500, as there is in a car today.
Oh,
Uh,
So that's the kind
wow.
of level of semiconductors per humanoid going forward. So pretty exciting once you get the volumes.
And big opportunity, it sounds like. Big roadmap.
Big opportunities going forward. Again, once the volume is here and we're on the cusp of adoption, it's really just about volume and ramping it up. So that's pretty exciting for 2027.
God, we got hyperscalers, we got humanoids. Things are changing pretty fast,
yes,
guys.
they are. And now we've got a market stake on a classic Hollywood gab show staple. Who wore it better? And today's runway is all about the AI race, but with a twist. Do you win it by spending the most or by shipping the best experience to the most people? On the left catwalk, the CapEx Sprinter briskly struts. This look is pure arms race energy. An oversized utility jacket with server rack quilting, a heavy belt that looks like a power cable, and boots so thick they feel like they're built for a data center floor. It's loud, it's modular, it's build it bigger, build it faster. On the right catwalk saunters the design purist. This is a quietly expensive fit. Clean monochrome, a crisp black turtleneck under a razor-tailored coat. The only flexes are a few subtle wearables, sleek AR glasses, and an AI pendant pin, discreet and effortless. So David, when you look at this AI cycle, who ends up wearing it better in the long run, the CapEx Sprinter or the design purist?
Great question, Jared. My money is on the those who wear it best, I would say. So for those who can deliver that experience,
Mhm.
basically, to the consumer, I think they're the one who kind of win out in the end. And it's interesting right now. We can kind of even start to see a kind of move towards the edge, basically. So, to what we talked about earlier, the monetization, the monetization does happen at the edge. And yeah, for those models to go into edge devices, whether that be the AR glasses, your smartphone, and if you can deliver that user experience, that is where that's where the money is, and in the long term. As I say, right now the money's on the infrastructure side, but kind of that pots of gold shift as you kind of move through the technology evolution. And I think long term, for instance, guys like Apple are in a perfect position there
That aren't
to kind of
spending billions or 700 billion
Yeah.
on CapEx. Yeah.
And what's interesting is Apple kind of has been the one to fall behind, but could this new technologies, new products sort of put it ahead?
Yeah, I think we're entering the kind of AI agent basically era now, and we've seen the disruption to the software models we talked about. Also kind of as those agents get deployed more on the inference side of things, they end up on our smartphone, and that's where the kind of value is to be realized. So yes, Apple has been kind of behind, I would say. I mean, that's a fair comment. It's done recently the deal with Google on Gemini.
To have it via Siri.
To have it exactly for Siri potentially, and once that can drive a big upgrade cycle as well for someone like Apple. But again, Apple is very focused on the user experience, and once it gets that right, then it's in a perfect position to leverage that massive install base it has. So yeah, I think on Edge AI, we're pretty excited about Apple long term.
We've talked so much about AI. We've also folded in robotics. Anything else in chip talk that we kind of left out here that's exciting to you?
Yeah, there's AI itself is happening is accelerating the whole chip design process. So chip design itself is embracing AI, just like on the coding side of things. Coding obviously has embraced significantly AI, and even by the end of this year, about 50% of software coding is going to be done by AI, basically.
And it's going towards machine language instead of all these structured languages, it seems like.
Absolutely, absolutely. I mean, it's still text kind of based, but a lot of these models have got to a level now they can, really accelerate product cycles, and that's pretty exciting for the tech industry in general. When I was designing chips, it probably could take you anywhere from 18 months to 2 years to really get the product right and get it kind of out the door. And I think AI enables us to accelerate that going forward. So faster design cycle is better for companies, better for businesses, and better for consumers.